Yes, you've seen the title right. I just bought more Alibaba. Let's talk. So I believe most of you have already watched my previous video on what the heck is going on with Alibaba. So in a nutshell, whatever can go wrong probably went wrong over the last 1 or 2 months. So a weakening economy, everyone calling for a property bubble for years, but there was barely any progress, catastrophic bank runs, China calling in the tanks to stop protesting, escalating China-US tensions again over Taiwan, perpetual lockdowns, continued crackdowns, fines again and again, shareholder unfriendly maneuvers, and to put the nail in the coffin, Hefka delisting again. So what exactly changed when comparing 7th of July and now? The like button. You smashed it then, why are you not smashing it now? Send the like button home now. Also, this video is sponsored by Weibo. So in case you didn't know, Weibo recently leveled up their game. Every single new signups can get up to $120 USD worth of Microsoft shares. I'll leave the link and instructions down below. Essentially, you just need to deposit a minimum sum of 2,000 Singapore dollars and execute a total of 6 trades in the first 30 days. So 120 USD reward for depositing 1,400 USD. That's an 8% ROI in 1 month. Definitely better than Alibaba. Jokes aside, Weibo also allows for investing into fractional shares, and I don't know why this is not a common feature for other brokerage platforms. So they pride themselves in zero commission trading as well. Don't let this 8% ROI deal get away. Link in the description. Now, getting back to the video. Anyway, after mentioning the myriad of problems with Alibaba, the natural question would be, why am I still buying? So truth be told, I highly suspect that I fell in love with the stock. So jokes aside, for the macro conditions of the economy, we can't really control them, and we are not in the position to control them anyway. That said, it is all part of a broader cycle of expansion and contraction, and it's not like it's the first time that we are seeing it. So there was once, back in 2015 as well, particularly cracking down the shadow banking space. Truth be told, if I don't pick up stocks when China looks like it's ending, then when should I be buying them? When everyone is chasing all-time highs after all-time highs back in 2020? Secondly, for all the naysayers talking about the bank run, property bubble, etc., they probably don't even know the actual ground situation in China today. I'll admit to that as well. I don't profess of having a very deep understanding of the developments in those arenas and areas as well. That said, I think the key difference between bulls and bears of China is how they view the aftermath and what will the government do to help resuscitate the situation. For one, they will definitely not haphazardly flood the economy with stimulus in hopes of artificially propping up the demand again, because if they wanted to, they would have done it a long time ago. So the difficulty now lies in how to balance the responsibility and effectiveness of any policy measures that they're going to introduce. So I for sure think that the government wishes to come to an amicable conclusion for both the banking saga and also the property crisis. So people tend to forget that solving problems, especially complex and systemic problems, require time. Everyone wants to see results immediately, now. What the central government is doing today, what the local government is doing tomorrow, what businesses are doing the day after. Chill, my friend. Everyone says that they're a long-term investor until they really get tested, and then you see how diamond their hands are. So anyhow, to just provide you with an overview of my current position, this is the breakdown. So compared to my last update, I've added 8 more BABA shares at the 10 something price point and added 200 more 9988 shares at around $93. Hence, this brings my overall exposure of Alibaba in my portfolio to about 75%, at least on a cost basis. So let's not talk about its current value because it's abysmal. So for reference, I have a grand total of around 310 BABA share with a cost basis of around $142 per ADR. And based on last Friday's closing price, I'm sitting at a give or take 37% loss on Alibaba. Cheers! I've also continued my DCA strategy for both KWEB and VT. I'll keep buying them until I die. Okay, maybe that's a little too much of a commitment, but I'll just keep buying them as long as I have enough cash flow and it's not negative. So VT, Vanguard total, is essentially flat, while I'm currently down around 15% on my KWEB position. So despite KWEB being sort of an ETF, it is highly volatile due to its concentrated and China nature. So nothing China related is peaceful, by the way. So moving on, I've held on my Meta position steady. I did not decide to trim or add to that position. I've explained my entire thought process in my previous Meta earnings breakdown, so do catch it if you're interested. Likewise, for most of the positions that I hold, Alibaba, Meta Platforms, Tencent, they are not quick speculation plays, and they probably won't moon by 100% in 1 or 2 weeks or so. So that's that. So the quarterly earnings are definitely great checkpoints to check in with the business fundamentals and probably reassess whether these said companies deserve to stay in your overall portfolio. So in short, for Meta, I'm slightly skeptical, so I don't intend to increase my exposure anytime soon and will give them some time to sort out their mess. So I'm still bullish on the company, but conviction is not as entrenched. For Tencent on the other hand, I'm still looking for a better entry to average down. So I think it has been swinging in that range for a few months now, and unless it gets to really attractive valuations in the short term, I don't think I'll be touching it anymore. So moving on to my $15,000 portfolio, it's really green, and not because of my superior stock picking skill, but purely because if you were to buy any or most of the big American companies, at least in the last 1 or 2 months, they have rebounded strongly after the recent tech earnings, other than Meta of course, Lamau. I'm still quite surprised that Amazon is already in the green by 30%. So it's a mega cap with a $1.3 to $1.4 trillion market cap. Think about it. The volatility of today's market is just insane. But anyway, on a portfolio level, my Amazon position doesn't even move a needle. Truth be told, I was waiting for Amazon to collapse further to the downside to add to that position. So will Amazon come back down again? Only time will tell. But I'm still in the process of trying to understand the company. So I still don't regret my decision of not buying trucks of Amazon then, because until now, I still don't think I understand the company enough. Even more so after looking through the recent earnings from Amazon. It got me even more confused afterwards on why and how are investors so forgiving and can look past Amazon's bottom line so easily. So would I miss the boat on this big bad guy? Sure, but I believe in the curse of Tay falling knife cheeking. So I thought Amazon's report was quite meh, but everyone decides to send it to the moon. Nice. So last but not least, this Taiwan semiconductor position was probably propped up by their monstrous earnings recently and Intel's abomination. So I think there's a really fine line between deep value and value traps. And personally, I'm still learning to read past numbers and assess the integrity of the business model objectively. So value stocks can over time become deep value, while expensive stocks can continue to command an even higher premium down the line. So at the end of the day, your job as an investor is to dictate which hill you want to die on and which battle to fight. So I'm picking fights in both arenas to gain experiences, and I hope by sharing my thought process, you get to benefit along the way. So it feels like everyone is back on clouds 9 again after the recent earnings call, with this recent recovery, and there are plenty of commentaries calling for the bottom. Personally, I'm still leaning towards being bearish in the short term. So I don't think the market has appreciated fully the extent of monetary tightening yet. In fact, it feels very much like everyone is desperately trying to find reasons to justify the markets to continue creeping upwards. So inflation is allegedly going to be solved real soon. A technical recession means that the Fed would not dare to continue push rates up, and big tech, excluding Meta, reported more than spectacular results, notwithstanding the inflationary and also recessionary pressures, and also the high base effect coming out from 2020 and 2021. So this definitely don't feel anywhere near capitulation, and retail money keeps flooding into the market. You want to see people losing hope? Look at the Chinese market, bro. So I won't dare call the bottom of the Chinese market or even claiming that retails are capitulating, but investor sentiments are definitely worse there. So I don't think the broader US market is even anywhere near. That said, if they do manage to pivot the US economy, resolve inflation, calm commodities and energy prices, then everyone can continue singing Kumbaya again. Then sure, the stock market will continue climbing. So with that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!